Hi, this is Randy Finney with Right Side of the Chart, and this is a early to midish session update for Monday, May 12th, 2025. It's 10:58 a.m. Eastern Time. I'm starting the video, so we're a little over or almost an hour and a half into the trading day. Figured I'd get one out there with my thoughts. We get some big moves in both the market and the miners today. I'm going to do this opposite. I'm going to start out with gold and the miners briefly, so I don't forget those. I don't have anything to add. I will reiterate what I've been saying on the equity markets. My trading plan remains as clearly and continuously stated recently, and I'll get to that in 1 second for the equities. On the miners, we have gold still holding below the at least double or triple sell signals we had, the bearish engulfing candle, the island cluster top, and the trend line break that all came right and right around the same time there. And so, it's still holding up. We got to give it that. It's holding up relatively well. But again, the big trades that I usually do in lieu of gold, you can get more bang for your buck, or GDX and silver. GDX still grinding around back to T1 now. But it's another great example of why I like to diversify among different asset classes, unrelated securities. You've got GDX down 6.55% right now, while the NASDAQ 100 is down, I think about half of that, 3.15. Yeah, so more than an offset there on GDX. But let's go back to the miners. So that's it. So we're at that T1 level again. Remember, we hit it here. We had a divergent low. We got a little bounce off that divergent low. And that remains, was and still is the first key support level, hence the reason it was the first price target. Typical reaction, that's usual upon the initial tag of each target. A bounce is likely. We got the bounce, so now we take that out. T2, T3, and I'll make a decision soon whether to extend or add any additional targets. As of now, remember, this trade was put out here at the time. T3 aligned with the uptrend line, but I can tell you right now, as I believe I did last week, that the uptrend line is going to come in before that T3, the price level there, about 42.67. So the trend line to me is a little, it's still a potential trend line because we only have a couple reactions so far. Either way, we'll just call this we're not even to T2 yet. If we go to T2, we have to drop another 5-6% just to get there. So I just want to give you that update there, and it's part of the gold was getting that risk on flight to safety bid, so it's going the other way right now. And again, it's the closest thing, I guess you would say, to indirect hedge, and it certainly would be called that, an indirect hedge to a short on the equity market. So that's how the miners look. Silver's got this uptrend line right here. Remember, we're coming off this divergent high, and it's been just flirting with that trend line right there. And so if we continue to see, remember, it's all about the dollar, really. The dollar moves inversely to gold, and as I've been stating, we broke out of this. This was also very long-term support. Let me just recap again. I sometimes forget there's always new folks coming in. Right there, this long-term. This is a weekly chart. Very, very key, solid support. This multi-year trading range right here in that purple box, and so that's what we're doing. We're coming off that level, and as I like to do, you hone down to on the 60-minute charts, gives you a little more precision. Bullish falling wedge breakout. We hit that first price target there. We consolidated below it between the first and second resistance levels. Then we popped up, as expected, went up, hit my next target there, 27.78. As expected, pulled back off the initial tag, and now we gapped above it today. There is a little gap right here, but either way, these were the same targets that I gave you initially before this wedge even broke out. So that the way it works is whether we go straight up to that next target or down. And what I think will happen is, and I've been saying this for the last couple of weeks, if and as we go up here, each tick higher, there's not like a flash point, but if and as this trend continues to evolve, this near-term uptrend here, more and more eyes, if you will see it and recognize. And it's going to have, even if eyes don't see it, I know a lot of traders, especially retail folks, don't know about the relationship between gold and the dollar. And either way, it will exert its forces. Again, the forces being a stronger dollar is bearish for gold. And so ultimately that, like I said, if this continues up, which I expect it to, But if it doesn't, then all I can tell you is this is net bearish for gold, higher dollar if that continues up, while this is net bullish, especially if we take out the recent lows, because now we broke that long-term support. Again, this long-term trading range there. And again, I expect, and have been at least to rally up, maybe a back test of this trend line, maybe a little bit more. And that will most likely determine, not absolutely certain, because this is an on-off relationship, but it's more on than off, meaning the inverse correlation between gold and the dollar. And so that's that. So there's your kind of your update on the metals. And again, you've got gold, GDX, silver, all that support. So we need to kind of break those support levels to open the door to another leg down. Otherwise, we can't rule out new highs. Okay, let's just go over to the equity markets. So just to reiterate and recap, my trading plan was and still is. We were long here off the recent lows. Coming up here, give you a bounce target zone. It was wider than most of the re-entry points that I usually give. My plan was to scale, well, actually, to allow for move up to 500 was always the number I was looking at, even though I had the box there lower, it was right around the 200. And I told you my plan would be to scale up to, but not above the 200. So that's it. So, and I'm talking again, long-term. I'm talking the long-term. I got long-term swing positions. Active trading has a little to do with that, but that's the long-term plan. And so hold off. As I said, that wasn't the all-in a moment. I'm not going to add to any short positions until and unless this uptrend line in both QQQ, SPY, and the majority of the top holdings that I've covered recently in the S&P 500, that's tech sector, financials, healthcare, discretionary, communications, they need to break their comparable trend lines, and they haven't. So where we're at. So at this point, again, my preference or my plan is to scale out if and when. Now I'm going to wait for at least closing, look at how we're looking in the close, and a big number is going to be today's high. We're not far. We are right now, I don't know if you can see it watching the video, we're at 503.95 as I talk. 500 is the bottom of this trading range right here. That's the level I've been talking about. A 1% move over 500 would bring you to 505, right? That's simple math. We are well below even 1% above that level. So to me, it's not, at this point in time, I'll call it concerning, if you will, for lack of a better word. I don't, it's just wrote, I'm going to follow the plan. If we come up here, and especially today, I told you this morning, I did follow up in the post. I was typing it, truncated it, hit the send button, and I didn't finish that sentence. I added it back. I'll get to that 1 second. But that remains my trading plan, and I'm going to wait and see how this closes today. I expected a fade at the open. That's what I posted this morning. Again, got that out to you. So far, it's been nothing big, but about a 1% fade, and I expect more. One of the reasons, not just technically, I'm going to get to that in a second. We're going to look at the longer term charts. Fundamentally, if you recall a few weeks back when most thought the sky was falling, the world was coming to an end, I made one what I call I can all but guarantee. I try to be careful using the word guarantee or promise anything, but I said I can all but guarantee you one thing, that the U.S. and China, which are the two largest economies in the entire world, we're playing a game of chicken, and that would not continue. So I will have to admit that I'm a bit surprised that there was such a positive reaction, because the guarantee I gave you back then is it would be sooner than later that those two would come together, hold hands, and sing kumbaya, that you would not continue to see 100%, 100+% tariffs on the two world's largest economies. That Trump can say what he wants to say, but we know we're as dependent on China right now as they are on us. That's just a hard stop right there. And so this was all 100% guarantee. And so all along, this rally was anticipated and expected. And again, it's a bit surprising that there was that much strength on the final news. We knew they were going to meet and discuss this weekend, and we knew it was inevitable. You could not sustain this path. And again, the market was pricing it in. They knew that you just see one positive tweet after another. Obviously, the news flow changed as anticipated back here. First, stocks rallied, then the news flow started changing. And this to me sounds about as much of a crescendo, if you will, of good news on the trade war front is about as you get. And of course, it's a 90-day kind of agreement. It's going to be revisited, but I can't imagine, on at least on the trade front, what could be bigger news than China and the U.S. reaching a reasonable agreement. I can't imagine what comes out. What, Zimbabwe? What else are we gonna, So that's about it. So again, and now the markets will turn to whatever they need to turn to. And again, this is a one-day move so far. We'll see where we finish. And again, I think up above here again. If like I said, 5% move would be over 505. 10%, I'm sorry, 2% move would be a 510, and so that is and will remain my scale and plan. Let's see where we look to close today. I'm sorry, scale out. As of now, sitting tight. Again, I don't have a full allotment, nor will I, as I said, unless we fall back below the mainly the trend lines. And again, QQQ SPY. I'll get to SPY in a second. Let's look at the weekly chart. And this is where, when I'm long-term swing and trend trading, I will often give the highest priority to what happens on the weekly chart. So this is QQQ. You can see here the blue line is the 40-week SMA, which is equivalent to the 200-day moving average, simple moving average on the daily chart. However, this is using a weekly, so it's going to, the number will be off a little bit because they're calculating on a weekly time frame. But there's 5 days in a week. That's why you get a 40-week moving average on a weekly chart, or 40 period is same as a 200 daily. Again, levels will be slightly off, but so we'll see how this closes, and that will be a big thing. But as I told you before, and you can see it here in the histogram. Here's the it's a custom histogram that I have, and this is the percent trading above the 40-week moving average. So I've set up a histogram here that shows you when the histogram's red, means the NASDAQ 100 or whatever security, in this case QQQ, is below. And so this week is far from over. And based on my analysis, my expectation where things were going, we'll continue. We'll keep this red this week. It means if that's the case, it's going to be a nice fade of today's rally. It's going to get us back below that 200 simple. And again, then if it does that and it takes us below the trend line as well, the uptrend line, which is on the daily chart, then that's where I will consider adding. As of now, my concern lies more so with subtracting or scaling out of those positions if we continue to rise from here, especially get up and look like we're going to close, tomorrow above today's highs, or get out there intraday, maybe even today. We'll see. I'm kind of playing it by ear, but as of now, expecting and even more of the fade of the rally that we got so far today. And again, this is a great trend indicator. There's a bear market when you're below the 200-day or the 40-week. The trend is bearish. I know this is a busy chart. I'll turn off all my lines for you. There it is. And that's it. So that was COVID, bear market. The Q4 2018 drop, primary trend was bearish, big double-digit drop in QQQs. That bear market in 2022, and this one right now. So let's see how we finish the week. Was this just a blip like COVID, or one and done? Possible. Or is it something like this, like in a regular bear market? You always have that initial bear market rally. If you zoom in nice and tight, you can see that usually brings you back to test the 200-day moving averages. And again, intra-week, this at one point would have been green. I can see right there the candle was above it, only to close the week red, and kept that trend indicator on a sell signal throughout this entire period from there to there, right? And so we'll see how the week finishes there. And on SPY, the S&P 500, there it is as well. We say if you have to squint to see it, it's not really a buy or a sell signal. The SPY, the S&P 500 right now in the 40-week, if you look at the pop-up box to the left, the 40-week exponential or simple moving average comes in at 576.48, and we're trading at 579.38. Remember, you're talking a couple points on a almost 600-point security. That's a mere fraction of 1%. So we're effectively on the 200 right now. if you will. And we'll see. The further you get away from it, it's kind of just like what I said on the dollar a minute ago. The further the dollar gets away and rallies from that support, the more obvious it will be and the higher the impact it should have on gold. Likewise, if it goes the other way. And that works here too. We start building on this, and this week's candle, if we close a big green candle here, that's going to be hard to spin as anything but bullish unless it fails. If we put a second green candle the following week, because as I've talked about, it is not unusual. In fact, it's more than common to see these brief dip belows a week, usually by the second week. That was 1 week below, back up there. That was back in October, the October lows of 2023. We anticipated that, expected, allowed for it, and went long off that pierce there. And so I'm kind of looking the same thing now in reverse, where we'll allow for a little bit of what we call stop clearing rate above the 200s. And as I said in last week's video, I almost anticipated I'd give you about coin toss odds, whether we'd go up through the 200s briefly to blow out some stops or not. So where we go from here is important. That I can tell you. Again, it's incremental above today's high. With each tick higher, that gives a check mark, or if you want to took real-time probabilities, if you want to do it that way, each tick higher, not each tick like each penny, but every dollar a point or so in the SPY or QQQ is another percentage point higher probability that the market may go to new highs. But I still have that probability less than 50%. I still favor. If I didn't, I wouldn't still be short the fact that this is the tail end of a bear market rally, and again, just pushing the upper limits of that bounce target zone. So there's the indicators. We'll watch where they close the week. Let's go back to the daily chart real quick. Busy board here, I know that, but you can see this is the shaded box right here. That's my SPY bounce target zone, and again, we're just a hair above it. When I say a hair, everything's relative. Don't look at absolute points on a 600 point index. We're 1% above that level right now. So, and the day has a lot of time on the clock right now as I do the video. So there's the uptrend lines I want to see broken, and even better if and when we fall back below the 200s, because again, it is more than common to slightly you took them out there. You were above it the second day there. Actually, it was 3 days in a row. There was a slight pierce above the 200 there. That was on March 24th. We were above it the entire day there. You have to zoom in to see it, but that little doji candle remained above it. Back tested it at the lows from above. Traded above it on the third day in a row, but not far. And once it became clear to the masses that the breakout failed, it was lights out. Okay, and you can see similar action when you go back in previous bear markets. It's more than common to pop above it a little bit. So again, not to beat a dead horse, but that is an important facet to me. And I look at also the let's not forget on the 60-minute charts. As I've told you recently, I started talking about it here. We've had the first negative divergence on the 60-minute time frame, my beloved go-to swing trading time frame. I really like to see in big trends, bull and bear markets, 60-minute divergent lows and highs. We did the same thing. We went long on this divergent low after being short off that divergent high there. We rallied it back to the 200s back then, the market, QQQ and or SPY. Sold there, took the next leg down, went long, not for divergences, for other reasons that I cited at the time, covered shorts, went long. Now we have we had it here, and it's only bigger now, so it hasn't been taken out. The first negative divergence since the market hit all-time highs back in February, and the biggest drop that we had in many years followed. And again, this is right now negative divergence on the 60-minute, my beloved 60-minute time frames for both SPY and QQQ. This is just to move the needle here, move the DH, and that was at last when we went low off, based on the 60-minute charts. When we went long off that divergent low, we rallied back, hit my preferred target zone to the button there, fell, and we're just a hair below what was back then and still is really that 500 level, my max bounce target zone this time around, and that's it. So there it is, guys. We are at the point where, and look, depending on you and where your outlook for the market is, look, I'm going to say it both ways. If you're bullish, we just broke above 500. That's the bottom of the trading range, at the top in the market here when we had this very well-defined trading range. So if you are bullish, absolutely you can go long. It's objective. I wouldn't do it. I wouldn't do it with your money, but chase this rally. This is overextended with negative divergence. But again, I'm giving you what's objective with a stop somewhat below. Somewhat is up to you. You can have a tight stop below 500. You can have a stop below the 200 simple. Go back to the daily. You can go, again, a stop below the 200 simple moving average, or 200 exponential, somewhere in there. That would be a max stop for those of you looking for new highs and beyond. Likewise, if you are bearish and short and you have dry powder, see, that's why I speak to my positioning, my outlook is not going to be the same as everyone's. Even if you try to follow, I scale in, scale out. I have multiple accounts. So let's say I came into today with nothing. Yeah, I probably would take a starter short position. I wouldn't go too aggressive again because we just broke above the 200s and we're a hair above 500. I would maybe, if I had nothing, take a starter fractional, maybe a quarter position there, add on a solid break down below 500, then add again on a break of the 200-day moving averages. That would be one thing. Or again, if you are bullish, maybe you don't want to chase today's rally, buy a pullback, a back test of the 200 simple or a 200 exponential if we get it, right? Because once you recover the 200s, then especially after a bear market or a correction, that's your first, if you get back above them, especially if you're overbought to get there, that is a golden opportunity to go long the back test, right, of the 200s. And that's what we were doing back here in January of 2023. We were 110% bullish with the FANG, overweight on the FANGs. Apple and Amazon were my two top picks. That was right in the first of the year, about January 2nd, 3rd, or 4th, whatever it was. And then we took out, after that, we took out the 200s. So again, this is a break above the 200s that most likely will fail. But if it doesn't, I just gave you a trading plan for both those of you that believe we're going to highs, new highs in the market, and a trading plan for those of you that think we're going to take out these lows and go to new 52-week or multi-year lows in the market. And that's it. No reason to make this a super duper long video. We're at 22 minutes. This is everything I've been saying for the last couple weeks, week or two at least, my trading plan and my expectation. Like I said last week, coin toss odds, whether we'd pop above there or not. Have a brief run above there, and then how I plan to trade it, whether we go up or down. You have plan A and plan B. And again, like to see these trend lines taken out. Oh, before I wrap up, let me just show you one thing real quick. When I go to, let's just go to weekly time frame. Let me park the 200. Well, we'll leave it there for now. Let me just get some more real estate on the chart here. Pull these down. And let's just look at the market leaders real quick, where they're at. QQQ a hair above the 200. Microsoft comfortably above, but when I put on the trend lines, I have we're flirting with right now that downtrend line right here. If you see on the weekly chart, there's the all-time highs right here. Let me tighten that trend line up a little bit. I'm just trying to, what I want to do before I wrap the video is give you a view on where the leaders are at, because if you want to know where the stock market is going, all you have to know where the big leaders are. So there's Microsoft effectively still testing that downtrend line off the highs right there. And it is above its 200s. That's one thing I will give it props for right now, but it's also a downtrend line resistance. Let me turn off all the lines. Here's Apple. Apple is still well below its 200s, a very important stock. I think we can all agree that on that for the market, both psychologically as well as mathematically, being the second largest holding in both the NASDAQ 100 and S&P 500. Trend indicator, which is the 200 or 40-week moving average, still red. NVIDIA still below its 200-day simple moving average, right between the exponential and the simple, or again, I should say 40-week, same difference. Trend indicator still red because it's below it. Remember, this histogram is just showing you if you're above or below the 200 simple and by how much. That's the differential. When you cross the zero line and it goes from red to blue here, that means you made a bullish crossover. So right now I'm on the third largest component of the S&P 500 there. So far, two of the three are still below their 200-day moving average. Amazon right now, got to give it props, popped above the 40 weeks today. We'll see how we close the week. This is a weekly chart. This is where I put the biggest emphasis on swing and trend, long-term swing and trend trading. So if it can close a week, that one gets props. It gets a check mark. If it closes a week above them, if it fails back below it, then that's bearish. Alphabet, well below it, not even close. So now we've just done the top 5. 3 of the 5 are below, right? Meta above after taking it out, back testing. So there's points for Meta. And Broadcom above. Tesla's just gotten above. So we'll see how we finish the week. If we finish the week and Tesla or a couple of these fall down, we're going to have the majority of those back below. Their Netflix really doesn't round out. It doesn't have the mathematical weighting. It's only a $489 billion company. We also have a short on Netflix too. It's an active short trade. Remember, you had a sell signal on that break of that trend line, and you can see on a hot day in the Nasdaq 100, it's down. That's not a good sign to see Netflix down. So good for us because we're short Netflix, and that's based on the 60-minute chart. So there it is. So we just need to pop that previous low right there, and that should take us down to T1. Okay, 26 minutes. I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.